that is 40 lakhs. Okay, so the salary transaction, friends, is here. See, subclause 3. Okay, any payment which is chargeable under the head salaries, for which any such TDS compliances have not been done, or paid outside India or to a non-resident, paid outside India or to a non-resident, if it is payable, the tax has not been paid thereon nor deducted. Now, first of all, this is one type of the TDS compliances. Okay, the tax has not been paid nor it has been deducted. But this particular provision is applicable to outside India or to a non-resident. But let's see the question first of all. Salary is paid to the manager. Okay. Now, whether this particular manager, where is he? Outside India, inside India, salary. Let's check whether any such data has been given to us. Okay. So, this outside India or to non-resident, this data has not been given to us. So, what we can do is we can say that in this particular situation, that salary provision, section 40A3. Okay. We don't have the data. So we will say that, okay, we don't have the clarity because this is only for outside India payment or to non-resident. Okay, and if tax was not deducted or not paid, then I would have disallowed. But this provision, I will say no, not applicable. Okay, now see this payment: 30% of any sum payable to resident. Any sum. This is any sum. This is all TDS compliances. Huh? Any sum on which tax is deductible at source under this TDS chapter, not deducted, or after deduction it has not been paid. Okay. So, if it is not deducted or after deduction it has not been paid, in that particular case, you have 30% to be disallowed. In our case, it is any sum, it is covered by the TDS chapter. Okay. So, 40 lakhs into 30%. Okay. So, we may say that 12 lakhs we are going to disallow because here it is only to the resident person. Okay, and this payment is not outside India, because if it is outside India, then straight away the section number will change. Okay, so I may say that 12 will be disallowed. Okay, so I may say like that 40 lakhs into 30%, 12. Okay, but tax has not been deducted. Okay, so I feel that I'll disallow. Now Mr. Himmat in Bangalore has filed the return and he has already paid the advance taxes duly. That means the tax on these 40 lakhs is already paid, but the employer has not deducted the tax, but the employee himself from his pocket he has paid the taxes. Okay, so this is a unique situation. Okay, and that particular situation is covered, see here, this provision. Okay, and this kind of a provision, this similar type of a provision is, friends, there in the other provisions also. Then that also I will show you. Okay, one second. See, provided further, assessee fails to deduct. So assessee has failed to deduct the tax at source. In the given case, I have failed. Okay, now, but the assessee is not deemed to be an assessee in default. In the first provision of section 201. For the purpose of that clause, it shall be deemed that the assessee has deducted and paid the tax. Assessee has deducted and paid the tax. It is deemed that the assessee has deducted and tax paid. So this is a situation that the tax is not deducted. But the receiver of the money, that means in my example, the employee, has already paid the taxes fully to the government, and there is no loss of revenue to the government. And this is what it is trying to say, that the sum is not been deducted. Okay, but at the same time, the other person is not deemed to be an assessee in default by virtue of section 201. And if you will go to section 201, listen very carefully. See 201, one provision. Okay, see 201. 201, consequence of failure to deduct the tax. Okay, now where person has failed to deduct, where person fails to deduct the tax, but the monies have been paid by the payee. That means payee is very honest person. The payee has received the 100% money, but the payee has already paid the taxes. Okay, so you have to prove that the sums are already paid by the payee. In that particular case, you will not be an assessee deemed to be into default. That means government is not losing a single rupee of taxes, although tax is not deducted. But government is not losing any money on account of the revenue on this particular front. Okay. Now, and not deemed to be an assessee in default in respect of tax if the payee has furnished the returns. In our question, he has already furnished the return. He has taken into account computing the income. That means he has not hidden the income. He has disclosed the income properly and he has paid the taxes. And you have to furnish appropriate certificate. So once this much compliances have been done by the payee, then it is fair enough. Now in the given case, he has already paid the advance taxes. The payee has already paid the advance taxes. Okay. And he has already filed the return of income also. Now, one procedural compliance is like you have to obtain a certificate, appropriate certificate. The certificate also, let us assume that is already obtained. In that particular case, this is a case of a deemed deduction of TDS and therefore no disallowance is to be warranted. See, no disallowance is to be warranted in this particular situation. I repeat that. I call it as a deemed deduction. Deemed deduction. I will once again repeat. Where assessors fail to deduct the tax and you are not an assessee deemed to be in default, it shall be deemed that the assessors deducted and paid the tax. So this is one of the, what should I say, special adjustment which is provided by the law. That means ultimately assessee will have to prove it that you have not deducted the tax, but at the same time government also has not lost the money. So this particular provision will get neutralized and there will be no disallowance in this particular situation. Now this kind of benefit, this is in fact a beneficial provision, is also applicable exactly duplicate even for the purpose of outside India or non-resident payment. Outside India or non-resident payment also exactly similar provision is applicable. And there is one more extra adjustment for that subsequent year benefit. That means if the TDS compliance is done in the subsequent year, exactly similar provision is also there with respect to 1A provision. Okay, so that is I just call it as a subsequent year advantage and subsequent year benefit where the TDS compliances have been done in the subsequent year. So that way, language of subclause 1, this subclause 1 and subclause 1A is almost similar. Only thing that under subclause 1A it will be 30% disallowance, but under subclause 1 it will be 100% disallowance if you fail to do the compliances. Okay, so now come to the question. So here I will just write a note and ultimately I will say that no adjustments should be required. Okay, I will assume that this is a deemed deduction of tax at source. Okay, the next point. During the course of the assessment, officers demanded the ledger copy of the repairs on building, bank book and bank statement with a view to verify the correctness of the entries in the books of accounts. However, assessor is not able to produce the same for the reason the books of accounts are seized by the GST authorities. Okay, so whether you can call for the copy of these ledger account and all that, yes, the assessing officer has the powers to do that. There is nothing wrong. Okay, next. During the year, assessee has paid 55,000 cash to a supplier of a raw material. However, the material was already received and consumed 2 years back. Beautiful, beautiful. See, I already explained that to you some time back that any such cash expenditure. Okay, so if you have already got the expenditure, supposing in the year number 1, and in year number 2, year number 3, if you are making the payment. Okay, so now you are in the year number 3 when you are making the payment. So in the year number 3, you do not have any expenditure because expenditure on accrual basis you have already booked it in the year number 1. But now only thing you are paying a cash of 55,000 and material was already received and consumed 2 years back. That means 2 years back you have already booked the expenditure. So now because of this particular cash, okay, aggregate limit per day to one person. That exact data not given, but you assume that this is aggregate payment to one particular supplier, and it is 1 day aggregate payment per day. It is crossing the limit of 10,000 rupees. It is already crossing the limit, and therefore in the current year it will be a deemed income. We will not say that this is a disallowance, because in the current year there is no expenditure, but it will be a deemed income by virtue of section 40A3. And I already explained that, but I think that I should repeat this. So I will take you to this particular barrack provision. One second. Okay, this section 40 capital A. 40 capital A. See subclause 3, that is a cash expense, and 3A. 3 and 3 are almost similar lines. Okay, where assessee has got any liability, you have already incurred a liability. Now you make a payment. So you already have a liability, you are making a payment. So in the current year, you have no expenditure. Current year, you have a liability. And that liability, you are making a payment in cash. Technically, it is not cash. Otherwise, then account pay check and all these kind of specified banking transactions. Okay. Then aggregate payment exceeds 10,000. Okay. In a day. Okay. So these are the hardcore points here. Okay. In this particular situation, it has been said that this particular money will be chargeable to income tax. It will be chargeable. That means this will be your deemed income. This will be your deemed income, because in the current year there is no expenditure. Because when you say you have expenditure, you will say I'm disallowing. But this is not expenditure year. This is a year of a payment of liability, and therefore it will be a deemed income by virtue of subclause 3A, this particular provision, and accordingly 55,000 I have to add to the computation. Okay, so add 55,000. As I already told you, friends, you please keep on updating your answer. Now, loss on sale of property at Mumbai, 1 lakh rupees. Debited to his capital account. The cost of the property was 10 lakhs and was acquired 4 years back. Mr. Kalpesh entered into agreement to sell the property on 1st of June of the previous year when the stamp duty value was 12 lakhs. However, the sale of the property was actually registered on 1st November of the previous year when the stamp duty paid was 5%, rupees 55,000. Advance money of rupees 1 lakh was taken by account pay check on 1st of June. This property was intended for resale, but due to slump in the market, it could not be sold since last few years. Okay, now see, first of all, this is a property which is intended to be resold. Okay, this is intended for the resale. That means this is a stock in trade. A stock in trade means you make any profit on this. This is going to give you a business income. Now, there is one concept of a stamp duty valuation. I repeat, there is one concept of a stamp duty valuation. Okay, so wherever immovable property transaction, we have section 43CA provisions. Exactly duplicate provision we have in capital gains also, and exactly duplicate provision we have it in income from other sources also. So wherever immovable property, the value, the actual selling price, okay, selling price minus cost, okay,